Hello friends, this is Vijay Bhambwani. I've been trading these markets since 1986 and through my videos and social media presence, I'm trying to help newbie traders to improve their trading performance. And in this video, I want to talk about what I promised you on my social media accounts as to how the average retail Joe, the average retail trader got boxed into a corner by the smart money over the last couple of months and how to decipher what really happened using statistical market data and learning from this data as to how you can decipher this same process over and over again in the future. Of course, no two situations are equally alike. What I'm telling you need not work in lockstep in the next rally or the distribution phase or whatever, but we'll keep coming and visiting each and every situation as it comes in our videos. So let's get started and see what really happened. Why did the retail traders and how, more importantly, did they get boxed into a corner gradually but surely since the last 8 months? Now, I spoke about pro-cyclicality, the Phalanx and the Pincer formation in my videos, and to that extent, I owe you an explanation as to why I said each phase would happen and based on what grounds. Now, this video is all about the when, where, why, how of what I said and what systems went into giving out such hypothesis. Now, remember what I'm telling you. Apart from pro-cyclicality and counter-cyclicality, which are basic fundamental economic concepts, none of this matter will you get in textbooks or in any guidebook or manual easily available in the public domain. The reason being that these are techniques used by real-world traders, veteran old-time traders. As you know, the financial markets are populated more by non-participating commentators and people sitting on the sides as a spectator sport and very few real-world traders. So, doers of deeds are actually a minority in financial markets. Now, since time immemorial, the non-participant guys have been basically the high decibel noise makers, and they also cause a certain amount of disinformation protocol, misconceptions, false data, maybe even not voluntarily, involuntarily, but this noise is what is absolutely dangerous. Now, my videos are specifically to that extent targeted at doers of deeds. Now, let's start the step-by-step process of what happened and why. In this video, I told you this video was recorded in the end of 2023, by the way. I told you that the year 2024 was a year of artificial bullishness thanks to general elections being held in almost 6 countries around the world. Economic data would be gravy covered. All right. Now, data would be massaged. A feel-good factor would be spread across in the countries. By the way, 50% or more of the global population was going through elections to elect their next leader. So the feel-good factor that had to be spread was huge. Obviously, stock markets had to go up. Pro-cyclicality is something that I expected. I said this in that particular video itself as to why I expected pro-cyclicality in 2025. The reason is very simple. All that artificial gravy that was being covered, covering the economic data would wear off. It's just like your makeup washing off when you sweat too much or step out in the rain. So that kind of trickle down effect would happen. And I've been warning you since at least 4 quarters, if not 5, that 2025 is a year you want to be careful about. I explained to you what pro-cyclicality and counter-cyclicality is in these 2 videos. Not only did I explain to you the concept of what pro-cyclicality and counter-cyclicality is, but how the prices are expected to behave, what should be your trading strategy in each and every phase, and how not only can you avoid losses, but you can also come out ahead and make profits during these markets. So If you haven't watched these videos, do make it a point to watch them now. Even a refresher value, watching them over and over again will not do you any harm, but will do you good. Here again, I'm 100% confident that this kind of work is not being talked about in the public domain, and you found it only on our channel. When did the next phase I call the Phalanx start? And why did I call it the Phalanx phase? What were the telltale signs and how you can identify it in the future? Now, I explained the Phalanx formation in a Telegram post. Now, my Telegram channel is a unique place which I find unique because on this social media platform, I can upload files of various extensions. So, PDFs, Microsoft Excel files, PPTs, voice files, video files, every kind of data file that I can conceive of, I can upload, which is not something that I can do on a WhatsApp channel or my YouTube community where I can put textual posts. So do connect with me. My contact coordinates come at the fag end of this video, in the description below the video, and in the pinned comment below this video as well. So in my Telegram post, I explained to you what a Phalanx formation is. A Phalanx formation is basically a Trojan horse. Now, for those of you who do not understand military terminology, and I use a lot of combat techniques, I'll explain why. A Trojan horse was a wooden horse, a gigantic wooden horse, hollow from inside, gifted by the Greeks to the people of Troy. Now, the Greeks could not defeat the people of Troy in a fair fight, so they gifted them this horse. Hidden inside the hollow horse were Greek soldiers. The entry of the horse itself was by deceit. It was intended as a gift. But once the horse is placed inside, which is why the Trojan horse is also a name for many viruses that infect your computer and mobile phones, because they enter inside and they create havoc, chaos. So this is precisely what that wooden Trojan horse did. Phalanx formation is actually a formation that starts out with stealth. Once it enters inside, once enemy soldiers enter inside the defendant's area, they form a phalanx. The Greeks used to cover themselves with shields from all corners. On top of their heads, on the sides, they used to flank. It used to be like a rectangular formation. Shields on all four sides and on the tops. So you could rain arrows on them, you could try and poke spears into them, attack them with swords, but they were covered by shields all around them. And then suddenly they would discard the shields and start attacking, moving on the outside from a very close formation. And the army, which was surrounding the defendant's area from the outside, would move inside and compress the defendants into a pincer. A pincer is nothing but a plier. You know, a plier that you use to tighten your nuts and bolts sometimes. So this pincer formation is, along with the phalanx formation, explained in that Telegram post. The hyperlink to that is in the pinned comment and in the description below. So it starts with stealth. Stealth means hidingly, very, very surreptitiously. But then after it's inside, it starts to wreak havoc. Now, telltale signs and statistics of how to identify this will follow. Obviously, the consequences are disastrous for the victim, and the victim in this case has been the average retail Joe, the average retail trader. Now, why do I use combat techniques so often? Because I consider trading to be highly competitive warfare, where millions more of skilled traders, more experienced than me, more richer than me, with faster computers, better hardware, software, internet connectivity, and better trading techniques and trading systems, are fighting with me to take away my money from me. It's not supposed to be easy. It's a kill or be killed world where either I have to kill the other guy and eat him for lunch, or he'll serve me up as a turkey on Thanksgiving and carve me up for lunch. Now, it's definitely not as easy as the Maggie noodle style advice that you're getting online about how you can make millions of rupees by trading in your lunch hour for 10 minutes and 5 minutes, and how it's as easy as child's play. I'm very sorry, I don't have any such get rich quick schemes and I'm old school. I believe in sitting in front of a computer, watching the computer screen for many hours. And I can't even promise you that you invest 20, 30, 40, 50,000 and you're going to become a millionaire. As a matter of fact, I've recorded this video wherein I've told you how much money a trader actually needs to be able to become successful as a trader. And do remember that video is recorded before SEBI increased the lot size and the margin requirement. So you'll probably need 25, 30, 40% more money than what I've specified in that video. And as for becoming a quick expert in trading, I have another video in which I have recorded about how many hours, how many days, how long will it take you to become an accomplished trader. Of course, remember, this is my point of view. You are always feel free to disagree with me. The comment section is open to you. My only request is be civilized and be polite, otherwise you'll be blocked. Now, like I said, the Trojan horse involves entry by stealth. And once entry is achieved, it is very difficult to dislodge the Trojan horse, the Phalanx formation. Now, when, according to me, did the Phalanx formation get injected into our financial markets? As far as I'm concerned, the beginning was 4th of June 2024. Do you remember how fast and furiously the markets fell? There were some stocks, especially some PSUs, that fell 10, 15, 20, one or two even fell more than 22% intraday. Now, these kind of falls are not something that occurs without selling. Do remember, prices fall because somebody is selling, prices rise because somebody is buying. And buyers outnumber sellers, so prices rise, and sellers outnumber buyers, so prices fall. Now, those kind of falls were not happening without a reason. As a matter of fact, nothing happens in financial markets without a reason, and because these are financial markets, the reason is also invariably financial. Unfortunately, the retail traders kept on buying greedily because they were so attuned to the idea of buying the dips and prices would bounce back very shortly thereafter that they thought this was another temporary decline and markets would bounce back. Sure enough, the markets bounced back, but for a couple of days, there was a huge amount of pain where mark-to-market payments were concerned. Now, that unfortunately was the beginning of the distribution by smart money. Remain assured, I'll be sharing data and data points backed by proof, and I'll also explain to you how you can decipher that. Now, take a look at this chart on your screen. Just see how after the 4th of June, markets have fallen sharply every single month. This is the daily chart of the Nifty, and what you will see is that after 4th June, the market has not only fallen at least once a month, if not more, but it has clawed back higher. It has even crossed the peak that it has fallen from, the earlier peak. So the market is basically telling you, don't worry, keep paying the mark-to-market loss. I'm going to come back right up. So people were actually selling their other hard assets or non-financial assets to fund the losses, trading losses in the derivative segment of long positions, which they should not have. Now, in spite of the fact that markets fell every month at least once, the retail continued to buy every month, paid mark-to-market losses, maybe even broke their savings like fixed deposits, mutual funds or whatever, and funneled this money into speculative losses. They absorbed the overhead supply and therefore the markets continued to stay buoyant. This is borne out by the MWPL. Now, MWPL, according to me, is one of the most powerful indicators that you and me as traders can monitor. I've recorded a video how to decipher the MWPL that I share with you and how you can plot it yourself. Not only the MWPL, the ticket size per transaction or TST churn ratio. How much is the turnover in futures as a component of the total open interest? The higher the churn ratio, the more is the smoke and dust which is being raised to fool the average retail trader. Do watch this video if you haven't seen it already. Now, the retail guy continued to buy on every decline every month, and then something exceptional happened. The market fell in October and never really recovered from that peak. Now, in terms of the price, it did not recover. But in terms of MWPL, the traders were not surrendering their bullishness. So they continued to buy and the market-wide position limits continued to stay buoyant. The torture and the burden of higher span margins and the mark-to-market margin was too much to bear. But do remember, October is more than one factor responsible for how the markets turned. It is on 1st of October that new lot sizes came into effect, higher margins came into effect, some more regulations about discounted margins for calendar spreads on options, how options premium would be determined close to expiry day and particularly on expiry day. Also, the STT, Securities Transaction Tax, was raised on 1st of October onwards. So the cost of trading went up, your capital requirement went up, your challenge level went up. So the market never really recovered from the peak in October. While the retail remained optimistic, they continued to buy the dips, but their capability to buy kept on shrinking. Now, after October, the MWPL also started falling. Now, like I said, from November onwards, MWPL started cracking lower, which you can see on the screen, on the chart on your screen. And this is evidence number one as far as I am concerned. Now, smart money has pushed the retail guy so much that he has been unable to buy any more on declines and add to his long positions. Not only is he not able to add long positions, but he has begun to surrender long positions, which is why MWPL started falling from November onwards and the smart money had smelt blood. They suddenly started stepping up their selling without even masking their action, and that too heavily. Because they just could not mask their action, mask their selling pressure. Why? Because they were selling in very large quantities. They could not hide it anymore. Now, take a look at the TST, the ticket size per trade on your screen. What you are seeing is that the TST or the ticket size per trade started going up as we head into September, October, November, and December 2024. What does it tell you? Now, basically, what is TST? Now, if you transact 2 lots per order, the TST will show as 2. If you suddenly start to trade 5 lots per order, the TST becomes 5. The point is that it requires big money for the TST to go up. A small guy, even though he wants to, cannot trade 50 lots of the Nifty easily. But a big guy cannot afford to trade 2 lots per transaction because he would be selling thousands of lots like this in bits and pieces of 2 lots per transaction. That would be a nuisance. So whenever the TST goes up, remain assured it's the big money coming out and buying and selling. And here, because the prices were falling, we could say that it was selling pressure. And like you saw on your screen, the TST told you that the big guys were not even masking their sales. They were just openly hammering the markets. Now see the churn ratio. Churn ratio, I told you, is a percentage of the turnover as compared to the total open interest. Higher the churn ratio, the more dust and smoke there is to basically throw the retail guy off track. I told you the churn ratio, the ticket size per transaction, and the MWPL is covered in that video. Please do see that tutorial video. As the churn ratio and ticket size per trade spiked higher, the MWPL fell. That was corroborative evidence number 2 and evidence number 3. Do you think this was a coincidence? As far as I'm concerned, coincidences do not occur. I was trained in my younger days to treat coincidences with a great degree of suspicion. And sure enough, as I'll present more evidence to you, this suspicion was well founded. Now, the retail was bearing the burden of rising cost of funds coupled with cost of carry. I showed you these charts a couple of months ago, 5 weeks ago, I'm sorry. I have proved to you that if you had gone long in the Nifty and in the Bank Nifty from October 2021, continued to carry forward your long positions, both the cost of carry, which is the rollover cost, and the cost of funds, which is the interest cost, which, by the way, I have been singularly telling you would go up from October 2021. I've been screaming across rooftops that your cost of funds will go up. Now, if you add the cost of carry and the cost of funds from October 2021, by middle of 2024, bulls were hemorrhaging money. They were in absolute losses. That is evidence number 4. Is this the sign of a bull market where a bull, if he is rolling over his trade month after month, is not even recovering his cost of carry? Forget about making a profit. No, it was not classified as a bull market at all. Which is why at that point in time, around the middle of 2024, I started pushing you, my online family, to study the work of Dick Stoken. As far as I'm concerned, he is the world's leading authority of his time on matters of cost of money, cyclicality of cost of money, and the impact and fallout, most importantly, of the cost of money. So, in a very graded manner, in a very gradual and timely manner, I've been basically upping your skills to cope up with the challenges that would come up ahead. Why did I not sound very, very bearish? Because I didn't want to panic an average retail guy. I decided I would basically teach you how to handle these issues one by one so that when the issue actually hit, you were prepared. Now, in my weekly video dated 17th of November 2024, the thumbnail which you can see on your screen here right now, for the first time, I use the word Phalanx on social media in the open domain. Why did I use the word Phalanx? Because I thought taking the weight of evidence of higher churn ratios, higher ticket size per trade, falling MWPL, the worm, the Trojan horse, had been injected into the bull camp, and the bulls would not be able to dislodge the Phalanx very easily. Their goose was slowly but surely getting cooked. Now that the Trojan horse was injected by way of a Phalanx in the market, I, at that point in time, started teaching you how to trade using tick by tick data in this video. I'm very, very happy. I feel a great sense of satisfaction that I receive a lot of positive feedback from a lot of my family members, online family members. Vijay, we have benefited significantly from all the free advice that you're giving. By the way, I don't provide any paid services, no mentoring, no hardware, no software, no algos, nothing. I'm a trader, a fellow trader just like you, and it's just my passion in the market that makes me share this data with you. So, when the Nifty and the Bank Nifty tick by tick data is something that I started providing on my free Telegram channel, unfortunately, SEBI regulations forbid me from putting up individual stock tick by tick data because SEBI says the minute you mention a stock, we will assume that you are giving buy and sell advice. I'm merely sharing the tick by tick data. The indices are exempt by SEBI. I'm not giving you a buy or sell. I'm teaching you how you can think for yourself as to whether it's a buy or a sell. But no individual stock-wise tick-by-tick data is possible unless SEBI changes its rules. Now, once the tick-by-tick data technique was grasped by some of my online family members, they started sending me a lot of positive feedback. I was breathing easier that these guys were actually able to handle their capital better through thick and thin. Guys who I'm very proud about, who've learned this tick by tick techniques like Shilpa, Rekha, Prashant, Aditya, Tarun, Alok, you guys have been doing wonderfully well and you've grasped the tick by tick technique fantastically. You're doing a great job and you have a great future in the market ahead for you. Now, for the final cut as to what the Pincer attack is, what really happened during the Pincer, and how the retail lost the maximum amount of money in the Pincer formation. Now, here again, the Pincer formation is something that I talked about on my Telegram channel along with the Phalanx. Just in case some of you, my online family members, did not read that Telegram post, the link is provided in the pinned comment and description below the video, of course. I made sure I sent out a WhatsApp broadcast of the Pincer and the Phalanx formation. And many of you replied to that. Now, the Pincer is nothing but a military tactic involving boxing your enemy into a corner so he cannot escape you. And then you pulverize him with attack after attack and annihilate your enemy after surrounding him. It will succeed provided the defender who is being surrounded stops fighting or loses the capability to fight with strength. Now, here again, you will demand data from me as to Vijay, how did the retail stop fighting? I'm going to provide you that data as well. Now, the retail traders were beginning to show signs of fear, nervousness, frustration, fatigue, and lack of firepower. What is firepower in a trader? Money. Now, this technique was first advocated by General Clausewitz, who is the first person to have written the first organized military manual over 150 years ago, titled On War. It was used highly effectively in the Second World War by Field Marshal Erwin Rommel and General Heinz Guderian and General Franz Halder of the German Wehrmacht, or the German army. Now, I saw it unfold exactly as per General Clausewitz's book in the financial markets right in front of my eyes, which is why I've sent you so many updates on the Pincer, on the Phalanx action, because it's coming out exactly as General Clausewitz put it in writing more than a century and a half ago. Now, this is the first time that signs of dipping started to appear. What is dipping? Although I mentioned it in my video more than 6 months ago, I've started using this term more and more on my Telegram channel. Dipping is disinformation protocol. What is disinformation protocol? You're driving a car. You're supposed to give an indicator as to which way you're going. So you start giving that orange indicator onto your left-hand side. So the guy following you in the car behind you thinks you're going to turn left. But hey, you turn right. What did you do? You just dipped him. Disinformation protocol. Why does it happen in the market? Because big money does not want you to know, you and me as retail guys, it does not want you to know what they are doing, because you might follow them, you might even front run them, and you might start to make, in percentage terms, more money than them. Not in absolute terms, because they'll come in thousands of crores of capital. You and me will have a far smaller capital, but they don't want you to make money off them. So they always dip you. They mask their trades. Now, this is the time when statistical data started showing me signs that big money was masking its trade, and that too big time. Why? Because the capability of the retail guy to fight back, which means buy, was falling. He was losing money. There was little money left. MWPL had started falling. Turnover had started falling. STT went up. Lot sizes became bigger. SEBI started collecting more margins, and the retail guy was choking for air. All right. Now, if the volumes have started falling, how does the big guy sell in big lots? Remember, his TST, or ticket size per trade, is big. What does he do? He starts to mask. How does he mask? He buys small lots. He tells you, look, I'm buying again. There were two ways the big guys started masking their trades. First, they would buy small lots, and then they would attempt to sell bigger lots. When bigger lots were not getting absorbed, what they were doing is splitting their ticket size per trade. Instead of selling 50 lots and 100 lots in one transaction, they were selling 5 lots in 10 different trade sizes. So it was coming to a total of 50 lots. How do I know? Because I collect the ticket size per trade Excel file for all the stocks I trade and many more that I don't trade but I monitor. So I noticed this a very peculiar thing happening in many counters. Like I said, SEBI forbids me from sharing individual stock-wise data. Otherwise, I would have marked out those boxes and I would have shown you how the big money was masking its trades and then hammering it across the throats of the retail guy. But this data is there downloaded by some of my family members, and I'm sure they're getting what I'm saying. A couple of weeks ago, I started warning you that this disinformation protocol would rise further and it would reach crescendo level because big money was unable to sell as much as they wanted to. So they would basically start throwing crumbs in the opposite direction from what they were traveling to so that they could throw the average retail guy who had some statistical knowledge and who was following the numbers, he could be misled if he was inexperienced. This is where experience comes into picture. Now, the extreme amount of disinformation protocol has a name and it's a military operation. It's called Maskirovka. In Eastern European military circles, it's called Maskirovka because when the Germans attacked Stalingrad, the Russians had to fool the Germans into believing that they were much more powerful than they actually were in defending their cities. All right? War is the best thing to study if you want to succeed at trading because trading is a form of warfare. Make no mistakes about it. So, how do you counteract Maskirovka of the smart money, which is an absolute highest form of deception by the smart money, by Matryoshka? Matryoshka are Russian dolls, wooden dolls. We in India also we've seen these dolls when we were kids. You open one doll, which is a papa doll, and there's a mummy doll inside. You open the mummy doll, there is a baby boy doll inside. And you open the baby boy doll into two, there's a baby girl doll inside, smaller than the other, progressively smaller. Now, this is like the very popular online GNU open source software called Tor. Tor stands for the onion ring. If you want to use online security, you can use the Tor system. It basically operates like very simple layers of security built after one more layer. Just like you peel one layer of skin of the onion till you reach the core, many layers later. Matryoshka analysis believes in peeling the statistical data one layer after the other to reach the core of the data, and the disinformation protocol or the Maskirovka is all there to hide the core of the real intent of the trade, which is why we designed our in-house statistical model, the IBEX, to peel out layers and layers of this data and arrive at the core. So then I told you that Maskirovka has started occurring in the markets and there would be huge amount of volatility and you need to be absolutely careful. And sure enough, a couple of weeks earlier, volatility hit the roof. Now, all through this Maskirovka and dipping, what was the condition of the average retail guy? He was undergoing extreme torture. He was losing hope, he was losing money, and he was losing time. Now, time and money, nobody can give you. Time, once lost, is gone. It's irretrievable. Money, when it's gone, can be arranged by way of a loan or by selling another asset, which the trader has to do himself. But hope is available by the bucket loads, especially from people who don't even trade, which is precisely what these guys were doing to the average retail guy. Hey, go out and buy, believe in the long-term story, look at what's happening and look at how the market is going to be 20, 30, 40 years down the line. Don't look at tomorrow morning. That's not how you build wealth. So hope was floating a lot, and hope is a four-letter word. You do not, I repeat, do not hinge a trading strategy if hope is what you're going to depend on. Now, whenever the retail guy got additional amount of hope, remember, he doesn't really have too much money, but hope makes him buy again. So what does he do? Now, he doesn't have money, margins are higher, lot sizes are higher, so futures are out. What do? He starts to buy options. Why? Because there are no span margins and there is no mark to market involved. You just pay what the retail guy says, only a small amount of premium. Unknown to the retail guy, that premium is a trap. Number one, it decays over time. Number two, when a whole lot of people are moving out of futures into options, demand and supply theory tells you that the seller of these options will start asking for a higher premium. What is premium? Nothing but cost of funds. So you pay a higher additional interest to go long by way of options, and options premium are decaying as expiry comes closer, so your chances of losing money are even more higher. Now please tell me, is this not a pincer formation? The pincer formation succeeds when the defendant is unable to fight the attacker vigorously. The defender in this case is the retail guy. Here is the data on your screen about how over a period of, this is a weekly data, week by week, how the retail guy has been switching from futures to options. These are stock futures and stock options. Unable to pay the futures span margin, the retail guy has been forced to go into option, hoping that this time around he will salvage his capital, recoup his losses. But hey, that's when the big money hit him. It asked him for higher amount of premium. The guy paid the higher amount of premium and he lost even that premium. It's gone, which is now the reason why the volumes in options are also falling. Now, this is something why I told you to read Dick Stoken's book free online, because options are dependent on risk-free rate or cost of money. And unless you knew Dick Stoken's theory, you would never understand what I was saying, because you would disbelieve me as a retail individual advisor or a trader. Now, options being decaying assets, as time progresses, the premium contracts due to time decay alone. Which is why in my these two options trading tutorial videos, I told you that I am a believer of writing options rather than buying options, because time and price both are stacked against the buyer. In futures, price is stacked against the buyer, whereas time is not really, because you can continue to keep rolling your future to the next month without erosion in premium. All right. So I in those two tutorial videos, I told you that theta decay, which is selling an option, collecting the premium as a return on the span margin that you're paying, is the best way to earn money from options, and which is what, as a trader, is what I do. The more distressed the retail guy got, the higher premium the savvy money made him pay. It's fine by me, absolutely fine by me, because I was on the other side. I was collecting premium. So I kept telling you that theta decay is something that you should continue to do. And I'm happy to know from the feedback from a lot of my online family members that they have collected good alpha by way of theta decay from non-linear derivative segment, which is the option segment. Now let me share my finding with you. I have reasons to believe that even the linear futures segment will start giving you theta decay at some point in time in the future. But by that time, the average retail Joe would have thrown in the towel. Is it that time yet? No, it's not yet that time. When will it come? I will update you by way of a video. Don't worry about that. Now this mission, this fight is far from over. The retail guy is boxed into a corner. He's in a pincer, but he's not dead. The big guys from the data that I'm analyzing are not done with the selling. What do you think will happen? Maskirovka. Some more deception, some more buying, some more hope with prices rising higher. Which is why I posted on all my social media accounts, Twitter, Facebook, LinkedIn, WhatsApp, Telegram, etc., that the pincer formation impetus or the force of fall is easing. And look at what happened on Thursday. The markets went up temporarily. This was a part and parcel of the Maskirovka that I'm talking about. This mission will be over when the last bull has surrendered and thrown his towel. It's not reached there yet. We are going to be there It's going to be tough, but in between, volatility will go to the moon and back, and it's not going to be easy unless you're reading your tick by tick data like a student studies his books before his college exams. Now, friends, will these techniques that you have deployed in reading the TST, the churn ratio, and the tick by tick data work across all scenarios in the market? No. To a very large extent, they will possibly mimic each other, but remember, no two situations are alike. When you're driving a car, do you speed on a sunny day and also speed on a rainy day and a foggy day? You don't. You adapt to the circumstances around you. So every time the market tone, tenure, and texture changes, a trader will adapt his statistical trading model and the behavioral trading model to adapt to the market and trade accordingly. I assure you, I will update you and provide you hand holding. And like I said, I have no vested interest. I don't provide any advisory or mentoring or any other paid service at all. Through my videos and my social media posts, stick with me and I'll see you through. So, I have a couple of questions for you. And at the end, I also have a message. I hope you've learned lessons about counter and pro-cyclicality, why I recommended safe haven buying in bullion in these videos, why I suggest investing some money in sovereign bonds so that it's away from the capital market, how I told you to read the screen with the snapcode window and the tick by tick data, why you should plot the MWPL ticket size per trade and churn ratio. Now, do you wonder why I'm doing this for free? Do you think I have a vested interest here? The answer is yes, I do, because I'm nervous. Why am I nervous? Because I'm worried that deep pocketed, AI powered, artificial intelligence powered, algo powered, high frequency trading desks from the West are going to come to our country. As a matter of fact, they've already landed here. Jane Streets of the world have already come here with deep pockets, big bags of money, swinging prices left, right, and center. So, local guys like me who run prop trading organizations as CEOs are feeling threatened. At least I am. The reason why I do all this is to meet fellow CEOs of prop trading organizations, get together, come over to my club, meet me over a meal. Let's get ideating, brainstorming, and nitpicking our knowledge and sharing our knowledge based resources. None of us need, with the grace of God, need anybody's money or each other's money. We are all comfortable in life. But what we need to do is stay profitable in the market, be present in the market, and continue to earn the rate of return that we are earning at this point in time. Because SEBI regulations, lot sizes, etc., are basically ensuring that it's getting to be a more and more capital intensive game. So, our profitable and efficiency of operations need to be raised a couple of notches higher. Not only do we need to raise the notches of efficiency higher, we should also not disturb the Jensen's measure or the risk that we undertake per trade. For every unit of risk, we should be getting at least 2 units of reward, if not higher. That is not something that we need to compromise at all. So, the margin of comfort, the margin of safety in our operations need to be basically kept intact. I'm 59 years old. I'm not yet ready to hang up my boots. I still have a lot of good trades left in me. I don't want to basically be retired by excessive competition that is likely to come and turn into a troll like people troll me on my channel, in spite of the fact that I have nothing to gain out of putting out these free videos. That is my vested interest. So if there is somebody out there who's running a prop trading organization and who wants to shake hands with me over a meal, you're welcome to my club. This is what my entire purpose of being on social media is for. Friends, I hope this video has added a lot of value to your knowledge bank and it's helped you understand the nitty-gritties of professional day trading better. In case you haven't subscribed to my YouTube channel yet, please do so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what other videos you would want me to record to help you better. And please share my videos with all your friends so as to enable me to reach out to a wider audience. I thank you for your patience in being with me in this video. I hope you have a very, very profitable day ahead. Take care. Bye-bye.